Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 3rd of October. My name is Fook Hien and I'm your host for the podcast. As I reviewed Q3 markets performance yesterday, I highlighted that September was the worst month for US equities this year, with the S&P 500 down 4.9% in September and nearly 7% below its peak in July this year. Of course, year to date, we're still looking at positive performance of nearly 12% to September. But what explains the weakness last quarter? There were some worries about a US government shutdown in October, but that was averted over the weekend, at least until the 17th of November. That didn't really help the S&P 500 to bounce overnight though. Well, US equities seem to be fearful of rates staying higher for longer, and at the same time, the US consumer, which has been propping up the US economy, is showing some signs of weakness. The credit card and debit card spending data has been trending lower in September. Student loan payments, which were suspended during COVID, have resumed this week and will reduce spending power. We also saw a decline in US consumer confidence reported last week. Overall, we expect growth to slow significantly into the turn of the year. And this brings me to the most important question, as said by Fed official Michael Barr last night. And it is not whether another rate increase is needed or not, but rather how long will we hold rates at a restrictive level? Or to paraphrase, how long will rates have to stay high? You see, the issue is, if growth weakens as we expect, the Fed could normally cut interest rates to support growth. But in the current environment, the Fed is unwilling to cut rates because they are fighting to bring down inflation. And the jump in oil prices by 30% in the last few months really complicates this, as it could keep inflation elevated. So let's focus on the outlook for US equities. The question of how long will rates have to stay high is also a top question for equities. High interest rates will hold back equity valuation as it impacts growth. I would add that a second big driver for US equities is corporate earnings growth. Now, the Q3 earnings season will begin by mid-October, and that will be a big data point, especially the guidance for next year. We believe consumer strength would be weakening at the turn of the year, but the S&P 500 is very much driven by large technology and internet companies which enjoy structural trends like digitalization and AI investments. Hence, we expect US corporate earnings to rebound next year, which is why we hold an overweight view for US equities over the next 6 to 12 months. We also expect the Fed will have to cut rates by Q3 next year as growth weakens, and that response would support US equities. So near term, the sentiment on how long will rates have to stay high will drive the equity market. But over 6 to 12 months, we believe earnings growth will drive US equities to outperform global equities. That is all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.